So you're sitting there, you have a portfolio, and you're trying to achieve a reasonable return, and you have this wide range of potential outcomes. Where do you invest? Are you just looking for things that are cheap, or do you need hedges in place, or what's your advice?
My advice, really quite simple. You emphasize emerging markets, you de-emphasize the US. If you have to own the US, you go for deep value. I did not say that 3 years ago, 5 years ago. But if I had to choose between doing that and avoiding the US entirely, I would do the latter. Secondly, and what the Grantham Foundation does, is I would own, where you can, VC. And in our case, we can own early stage, and we are over 60%. We target 70% early stage VC. And of that, we target up to a half in the green variety for not just for mission reasons, but because I think the top line opportunities will be way over average even in the VC universe for a long time.
You've been producing these 7-year forecasts, asset class forecasts, for a couple decades. And I've looked at every one you've done. I think it's probably at least 20 years. And the current one is among the most depressing that I've seen, where expected returns are in many cases negative, real, across the board. And there's a few pockets of value. It's quite depressing.
You only need one big asset class, by the way, to get rich. Emerging markets, as I said, it's way over half of the global GDP. It is growing far faster. And because of the size of China, it's guaranteed to do that. It's going to have a much better growth rate this year under stress, much better than the GDP growth of the developed world. So, and it's got 26 countries in it, covers every industry you would want. Why would you be moaning and groaning when you have such a good opportunity? It's 10 times earnings. It's cheap. It's a great opportunity. And if you insist on the US, buy venture capital, which is the last truly exceptional feature of American exceptionalism. By and large, in most of the things that matter to me, I have to make the sick joke that yes, America is exceptional. It's become exceptionally bad in that we have the worst life expectancy, the worst morbidities, the worst social measures of almost anything, children to 16-year-olds, number of people in prison, number of people who get shot, on and on and on. It's quite distressing. However, venture capital, we're the biggest, we're the best. And where does the talent go these days? The really best and brightest don't go to Goldman Sachs, Goldman Sachs, anymore, like they did in the financial bubble. They want to get into the VC business, to be mixing with things that really matter, and many of them to be actually starting their own enterprise. Do something that is useful, exciting, and will make them rich as well. What a great opportunity. I warmly recommend that to any young person who wants to be where the action is and where the significance is. Who wants to do a useless job? And VC is the most useful of any job in finance.
Leverage is extremely cheap, and if used wisely, can really boost returns. And I guess venture is a part of the way to play that. How do you think about leverage and being able to borrow at 1% or below and investing in something in terms of not fighting the Fed, not fighting Mother Nature?
Yeah, I mean, ironically, leverage plays the least role in venture capital. Most of them have relatively little leverage. It's equity money. It's kind of honest and straightforward, if you will. But why would you not take long-term cheap money if you can? Why would you not lock in a mortgage at 3%? Surely one expects to be able to do better than 3%. Even in terms of your career earnings, you might expect to grow them, or a lot of you anyway, at over 3%. And investing with a 3% target does not seem intimidating to me. The old rates of 15% maybe will never come back again, but 3% I think we can do. So why would you not take the leverage? And of course they do. And why would you be so worried about it? Let me just point out that debt is simply double entry bookkeeping. For every dollar of debt, there is someone who is owed $1. Why would I care if every other Japanese owns every other Japanese tons of money, so that in total, the debt looks intimidating by historical standards? Yet from a US point of view, looking at internal debt, it's totally irrelevant. And has proved to be, by the way. They have been moaning about Japanese debt levels for my entire career, and it has never had material consequences that I can see. They have plenty of things going wrong from time to time, but none of them have really come down to leverage. Leverage does not intimidate me. What intimidates me is interest cost coverage. And if the rates are low, you can handle it. And when you look at interest rate coverage, you find that the entire corporate system is in pretty darn good shape, well above average. If you look at the aggregate sovereign standard by the US, if everything was owed at today's rates, we would be far, far better off than normal of the last 50, 60 years anyway. So do not let conservative politicians and a few conservative economists persuade you that debt is a bone crusher. It simply is not. And even inflation is not that deadly. A moderate amount of inflation is completely compatible with a healthy economy, faster growth rates, and better treatment of the workers who have been sadly neglected in the US in particular.
And the Fed has vowed to avoid deflation at all costs and create inflation using all the tools at its disposal. Do you think they'll ultimately be successful? Because obviously they have a lot of tools to use, but when you look across the world, you look at Europe, you look at Japan, they have a lot of tools as well, and they've been trying for a long time without success. Where do you see this ending?
We have been gently sliding into deflation as a global economy, a couple of decades or longer. So I am actually very proud to say that I wrote quarterly letters for 20 years and I never featured inflation as a major risk. I've checked that, it's absolutely true. It wasn't a major risk, it hasn't been a major risk, and as far as I'm concerned, it isn't a major risk. However, at least now, for the first time since '82, when the long bond peaked out at 16%, can you believe it? At least for the first time, we can now sit down over coffee in the old days, put our feet up and have a conversation about the potential for inflation to come back. If you have a setback to the real economy, both supply and demand, as we've had from COVID, and you're throwing money at it to stimulate it, and you're throwing government works at it to stimulate it, you can reasonably talk about the possibility of inflation finally coming back into the equation. What we should expect maybe is that, particularly in raw materials, that one here and one there, food will become scarce, and then they'll address that and it will pop up in other places and so on. But to work through to wages, where inflation really starts to escalate, it's going to take a long time because we've had such miserable deflation in the typical average wage for so long that we are not in immediate danger of having them spiral out of control. Also, the power of unions have been eaten away by the force of circumstances and the force of right-wing politics deliberately for 50, 60, 70 years also. That makes inflation much less likely than in the 70s.
And you zoom out a little bit and you look at interest rates near zero for over a decade, trillions of dollars of printing, and inflation rates are falling across the world. It shows you how significant the deflationary forces are in the backdrop.
And I know I'm saying this now for the third time, is that the difference between monetary that you're describing and fiscal government spending program, which we really have not tried much in the last 20 years. We've been very nervous, particularly since the housing bust. And we have to get over that. Otherwise, we will revert to the slow, steady unraveling period. And I fear that. Much better to push too hard on government spending than too little, which we have done here and there, particularly in Europe in the last 10 years. We've really missed a great opportunity. So bring on the left-wing Democrats. Let's have some real government spending, and let's make sure for once that it's spun towards greening the economy and economic investments that will pay off for decades to come. I don't mind a bit of inflation. It doesn't threaten the economy. What it does is it threatens PEs. And that's something that you have to be aware of. Ben Inker and I designed a model 16 years ago to explain PEs. And it's factor number one, actually it's almost co-equal, is inflation and profit margins. Anything that makes the market feel comfortable is associated coincidentally, not predictively, but coincidentally. If you're comfortable, the PEs are high. If you're uncomfortable today, the PEs are low. And inflation makes you uncomfortable. High profit margins make you comfortable. The market today sits just about on the explanatory line. That is not a prediction, however, that's an explanation. The prediction would be, are the profit margins likely to get whacked on a global basis, on a US basis? Is society likely to turn against the FANGs and the social apps and so on? What is the potential to regress back towards more normal profit margins? And what is the potential for the virus to have a second round attack and bring down the profit margin? So the market is very vulnerable to profit margins, very vulnerable to even the hint of inflation. But in terms of the reality, the economy is very, very durable in the face of anything up to intermediate inflation levels. 3, 4, 5%. It won't affect the economy, but it will knock down price earnings ratios. So file that away in your brain and stay tuned.